I am concerned with the Fed's actions right now. I understand their desire to fight inflation, but I don't think they are looking into the financial markets astutely enough to see the damage they are causing to the plumbing of the financial markets. So they want to raise rates to fight inflation. I get it. But are they looking correctly at the stability of the financial system? And are they pushing too hard on the brakes over here such that the stability of the financial system over here is going to be a train wreck?
Hey guys, welcome back to Library of Wealth. Today we have Bitcoin maximalist Greg Foss forecasting the current financial market and where we're headed this year. Foss doesn't believe that the short-term Fed funds will rise to 4.5%, especially with the world already straining under 2.5%. This also shows that people now think that the Fed is currently doing nothing but job ownership. Foss notes that many things can rapidly spiral out of control, from financial trouble to a civil unrest crisis. A financial crisis would hurt. There's a sizable chance that things could go to the extreme. Let's listen to Greg Foss as he talks about the current financial crisis and the future of Bitcoin. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
The truth is, there is contagion in Canada of an eventual potential fault of a systematically important financial institution. That's what SIFI stands for. Systemically important financial institution, as deemed by the Bank National Settlements. So I don't know which one is going to hit the wall or hit your windshield like a bug hitting your windshield. It happens all the time. It is the catalyst that causes credit contagion that reverberates through the financial system and eventually up to the sovereign debt level. I'm not forecasting the eventual demise of Credit Suisse, but I will tell you the market is, because all I need to do is look at a credit default swap obligation on Credit Suisse, okay, lots of acronyms here, a CDS contract on Credit Suisse, and the cost of insurance has risen to levels never before seen, higher levels than during the great financial crisis. And if you just take what that means in layman's terms, it means that the cost to Credit Suisse to raise money, to bring money into the banking system, has the US 5-year rate, let's take 4%, and add on another almost 4% for credit risk for the bank called Credit Suisse. 4% plus 4%, their cost of funds is 8% before they've even made a loan. How many loans do you think are profitable that they can add an incremental loan spread on top of their cost of funds without taking excessive amounts of risk, i.e. lending to zombie companies, and then it becomes circular? So when your cost of funds is 8%, and the really good loans out there are at 6%, you're not making those loans. Why? Because you can't borrow at 8% and lend at 6%. You're going to lose 2% on your money. That's what it is. A bank takes money in at a cost of funds and reloans it and takes out the VIG, the spread. Okay? Understand, if their cost of funds is excessive, they have to forego a very important part of the lending market, the low risk part, which means they're lending to higher risk companies, which just causes the circularity. I know you say you weren't involved in this business in school, but just imagine that when you deposit money into a bank, you're really lending your money to a bank, and they turn around and take your loan and re-lend it at a higher rate and make that spread, and that's how the bank makes money. Pretty cool, isn't it? Until it goes kaboom, because people say, guess what? the loans you've made are silly, risk-adjusted loans. They're going to default, and therefore it's going to cause the whole system to collapse.
Foss believes that the Fed has begun to pivot and that a hard landing is to be expected. He says that a depression isn't likely, but we've already slipped into a recession, and that will probably worsen before things get better. Foss says that Bitcoin is an amazing insurance because it's free from counterparty risk and ISDA, and it has no time limit.
You nailed it. It's because all these financial institutions are intertwined, right? They have swap agreements with one another. They have, and when I say swap agreements, interest rate swaps where they swap fixed for floating interest rate obligations. They have foreign exchange obligations with each other. They have interbank lending obligations. Some of these are for very short terms, and some of them are for longer terms that you can't just say, oh, we're gonna take these off the books. It's a contract. You can't take them off the books at your own volition. So given that the banking system is so intertwined, where you have counterparty risk exposure over derivatives, over interbank funding or the cash funding, over all sorts of repo agreements and all of these intricate financial products, when one of the counterparties in the system, imagine a system like a bunch of gears, when one of these gears collapses, all of the other gears stop working because their counterparty risk now reverts back to them. Imagine if you, in the great financial crisis, you were Goldman Sachs. This actually happened. Goldman Sachs laid off a bunch of the risk from Goldman Sachs clients. They laid off a bunch of risks with this company called AIG. Now, AIG was a AAA rated insurance company that got way too far over their skis in selling insurance to the Goldman Sachs of the world, to the point where AIG was absolutely insolvent. And the Fed had to bail out AIG, not because they really liked AIG that much, but really because they liked Goldman Sachs that much that they knew that if they let AIG fail, Goldman Sachs would fail as well because of the counterparty risk exposure back to Goldman Sachs. It's not really that crazy to understand how this works, given that Hank Paulson used to work at Goldman Sachs. Hank Paulson was the treasury guy in the great financial crisis, all right? All of this is the Wall Street internal workings of the machine. And when one of the gears of the machine cracks up, all the other gears stop working.
Foss says the issue with the fiat Ponzi is that it begins with the commercial banking system. He explains that the central banking system has been the reason for all the obstacles in our financial world. This is because for their capital base, they're being levered up to 25 times. In a nutshell, commercial banks are requiring inflation so that their collateral will be able to escalate in value to recoup their decreased capitalization. Bankers have also been incompetently ignoring financial conditions, credit spreads, and the fact that the market is being ground to a halt. What do you guys think about Greg Foss's opinion on Bitcoin's decrease in price? Let us know in the comments below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.